Hey, junior core students, 4 or 5 students. This is Professor Fox coming to you. The professors and I have collaborated and decided that giving you a video going through some of the reading for chapter 7 would be helpful. So what the purpose of this video is going to do is explain to you the netting process, as that was not assigned to you as part of your reading. We purposely omitted it for this purpose. We were going to make a video. And so it's going to be modeled after 7-7, the example 7-7 in your textbook. And what that does is it goes through basically just kind of a straightforward example of how to net short-term versus long-term capital gains and losses. Okay. And the thing to remember here too is our basis of knowledge that we want to build upon is that really there's kind of these 3 buckets that capital gains or capital assets can be put into for tax purposes. We have the 0, 15, 20% bucket, but then we also have the 25% bucket and the 28% bucket to which capital gains could be taxed, right? So these kind of subcategories. We're not going to really focus on the 25% nor the 28% from a calculation standpoint. I mean, perhaps there might be a conceptual question about what those things are. And so you would just need to be familiar with what things are taxed at those rates. But what we're going to focus on for calculation purposes is the 0, 15, 20 bucket. So when capital gains are taxed at 0, 15, or 20%. Okay. All right. So with that said, let's jump into this example and go through the different scenarios. Okay. So it's a basic scenario of stocks, right? There are other investment types that you could have, holding land, stocks and then also, I don't know, art, whatever you want, collectibles, those sort of things get turned into investment properties that you hold for speculative purchase because you think you're going to be appreciating in value, right? Okay. All right. So that's what we're doing. Those sort of capital assets. Okay. So in this scenario, we have 4 stocks and we're going to sell them either at a gain or a loss. And the type is going to be either long or short term. We're going to switch these types between the scenario 1 and scenario 2 so you can just see how the netting process works more clearly. Okay, scenario 1. We're going to sell stock C and D, which are short term. D was a loss of 11,000, whereas C is a gain of 8,000, which results in a net short-term capital loss of 3,000. Okay. Now, for our long-term gains and losses, we sell stocks A and B, which results in a net long-term capital gain of $25,000. Okay. As you can see here, the signs are opposite, meaning one is a loss and one is a gain. When that happens, that means you can net one step further. Okay. If they're the same sign, so if both are positive or both are negative, you can't net anymore. Okay. So we know they're opposite. So now let's net one step further and combine the two, resulting in a net capital gain of $22,000. What's the character of that gain? Well, it's long-term because we had more long-term capital gains than we did short-term capital losses, right? Okay. So now we have a net long-term capital gain of $22,000. All right. Scenario 2 now. Now we're just going to switch the details. And as you see, it's just pretty straightforward. We have a net short-term capital gain now of $25,000 and a net long-term capital loss of $3,000. Again, they're opposite signs, so we can net them, which is going to result in a net capital gain, same as before, of $22,000. However, the character is changing because now we have more net short-term capital gains that we're netting against the capital losses, long-term capital losses. Okay, so the only difference there is a short-term net capital gain of $22,000. Okay, now, scenario 3, this is where we're going to do something different. So we've talked briefly or mentioned briefly the fact that there is a deduction for excess capital losses for individuals. And that deduction is $3,000. Okay. So when you have capital losses, net capital losses in excess of $3,000, 3,000 of it can be deducted, whereas the excess is carried forward to future years to be deducted in the same way. Okay. So in this scenario 3, we're going to introduce this short-term capital loss carry forward of $12,000 that we generated in the previous year, for example. Okay. So what that means is that last year, presumably we had a $15,000 net short-term capital loss, which we used 3,000 of it as a deduction, resulting in a $12,000 carry forward. Okay. And so there's some differences here with corporations because we've talked about capital gains and losses with corporations before. So corporations can carry back, individuals cannot. Similarly, there is no limitation on how far you can carry it forward for individuals. So these capital losses are carried forward indifferently, where for corporations, there's a limitation. Okay. All right. Going down to scenario 3. Now the way to think about this short-term capital loss is as if it's another transaction happening in the current year. Yes, it occurred last year. However, we're going to think of this as if it happened this year. Okay. So it was a net short-term capital loss carry forward that we had. So we're going to throw that into our short-term capital gains and losses. And as you'll see, it's just an additional line item there that gets netted into it. And our net short-term capital gain just gets reduced to $13,000. And we can use the whole thing. So that the thing to remember here too is we're using the whole amount of $12,000 because we have enough short-term capital gains to offset. Okay. So now when we go through the netting process, we just now result into a lower net capital short-term capital gain of $10,000. Okay. So what if in the scenario what about the scenario in which both capital gains have the same sign? So we have a net short-term capital loss of $10,000, let's say, and a net long-term capital loss of $12,000. Okay. So remember, I said previously, you can't net those two things together if they're the same sign. So what we're going to do in that scenario is we're going to remember what each of their characters are, keep them separate, and apply the $3,000 deduction to one of them. But which one? Which one does it come from first? And the ordering of that is first you want to take that from your short-term capital losses and use the $3,000 deduction from there first. Okay. So in our scenario, that's going to mean that we now have a $7,000 capital loss carry forward and a $12,000 long-term, or so the first one was a short-term capital loss carry forward of $7,000. And now we have a long-term capital loss of $12,000 that we carry forward in the future years to hopefully offset against capital gains in the future. Okay. All right. That's the basic rundown of the netting process. Hopefully that makes things more clearer for you and you're able to understand that a little more easily. Please let the professor know if there's more questions, and we look forward to seeing you in class. Good luck.